The active ETF wave, a comprehensive analysis. The realm of exchange-traded funds, ETFs, has witnessed a remarkable surge in popularity this year, with active ETFs at the forefront of this movement. In this article, we will explore the latest market trends, hear insights from experts, and delve into the dynamics shaping the active ETF landscape. Is this indeed the dawn of a new era for active ETFs, or are there nuances to the story that we need to uncover? A record-breaking year for ETF launches. To set the stage, 2023 is poised to break records for ETF launches, a feat last achieved in 2021. As of October, 391 new ETFs have been introduced, compared to 311 in the same period in 2021. The driving force behind this surge is the prevalence of active exchange-traded funds, which account for nearly 75% of the ETFs launched this year. This impressive rise in active ETFs is one of the most significant developments since their introduction in 2008. However, it's essential to dig deeper and understand the forces propelling this surge. Experts are contemplating whether this surge signifies the resurgence of active ETFs or is a phenomenon limited to specific players dominating the market. Expert insights: the active ETF space has undoubtedly experienced a significant uptick in interest this year. This could herald a new era of growth and development for active strategies, but we must also scrutinize the concentration of assets within a few key issuers. Are the majority of active ETF assets truly diversified, or is this a result of select players commanding the market? Financial analyst, Sarah Peters-Golden. Active ETFs, a force to be reckoned with. Despite constituting only about 6% of the total net assets, active ETFs managed to capture nearly one-third of inflows in September, aligning with the trend of active ETFs representing about 6% of ETF assets under management and capturing around 30% of flows in early 2023. Notably, active strategies have seen 40 consecutive months of net inflows until the end of July. The resilience of active ETFs in volatile markets. The success of active ETFs this year can be attributed to market uncertainties. The year began with concerns about an impending recession driven by earnings, although this scenario did not materialize. Instead, the market faced a mini-banking crisis, with the Federal Reserve persistently raising interest rates to combat inflation. Active ETFs emerged as a dependable option to navigate these challenges, and they largely delivered. Active ETFs outperformed their passive counterparts in the first half of 2023, with 57% of active ETFs surpassing their passive benchmarks or rivals, a notable improvement from December 2022, when only 43% achieved this feat. Expert insights: the resilience of active ETFs in the face of market volatility has been a defining feature of 2023. Investors have turned to active strategies to adapt to a higher-for-longer interest rate environment and safeguard their investments. The outperformance of active ETFs over passive counterparts has solidified their position in the market. Investment strategist, John Anderson. The dominance of a few. However, questions remain regarding the breadth of the active ETF success story. It's true that active ETFs have attracted a significant amount of capital this year, but a closer look reveals that the bulk of these assets are concentrated in a few major players, particularly Dimensional and JP Morgan. Excluding Dimensional's JP Morgan Equity Premium Income ETF, JEPI, and JP Morgan Nasdaq Equity Premium Income ETF, JEPQ, from the equation, the remaining 887 active ETFs have attracted just $27.2 billion in year-to-date flows, accounting for only 9% of the total flows into all ETFs during this period. This concentration of assets raises questions about the true breadth of active ETF success. While the flow of capital into these funds is impressive, it's crucial to acknowledge that this growth is primarily driven by a small number of issuers. Consequently, the active ETF landscape is more nuanced than a simple narrative of universal success. Expert insights: the dominance of a few key players in the active ETF space raises important questions about the sustainability and diversification of this trend. While active ETFs have garnered significant capital, the market dynamics are heavily influenced by select issuers. Investors must carefully evaluate the implications of this concentration. ETF specialist, Lisa Mitchell. The cost dilemma: active versus passive. A crucial factor to consider when assessing active ETFs is their cost. Active ETFs typically come with higher expense ratios compared to their passive counterparts. The active management approach requires expenses related to research analysts, portfolio managers, and more frequent trading. Despite the potential for active ETFs to generate alpha, these higher costs can often erode their performance when compared to passive index funds. Investors may wonder whether it's more prudent to invest in a passive fund with lower fees. Expert insights: the cost factor is a significant consideration in the active versus passive debate. Active ETFs are known to have higher expense ratios, which can impact their ability to outperform the market. Investors must weigh the potential benefits of active management against the associated costs, especially when low-cost passive alternatives are readily available. Investment advisor, Mark Collins. Diverse offerings in active ETFs. Active ETFs encompass a wide range of thematic strategies, including asset-based themes and various investment styles like total return, hedged, or buffer ETFs. This flexibility distinguishes them from traditional index-based strategies. However, it's crucial to recognize that the passive ETF space is also becoming increasingly saturated, further highlighting the appeal of active ETFs. While many associate active strategies with risk-conscious funds, it's important to remember that active ETFs have the potential to outperform passive indexes. They can swiftly adapt to dynamic market conditions and benefit from experienced managers who understand different sectors and their responses to changing market environments. Expert insights: active ETFs offer a diverse set of strategies and the potential to outperform passive peers under the right conditions. Their flexibility and the ability to adapt to market dynamics are appealing characteristics, making them a valuable tool for investors navigating uncertain economic environments. Market analyst, David Chen. The debate continues: active versus passive. The discussion between active and passive management in the ETF space is ongoing. While active ETFs have gained significant momentum in 2023, it's essential to evaluate their performance, costs, and the concentration of assets in a few major players. The allure of active ETFs lies in their potential to adapt to market dynamics, but their success is largely concentrated in a select group of issuers. Moreover, investors must consider the higher fees associated with active management and compare the potential alpha generated against the cost. The active versus passive investing debate in the ETF space is likely to persist as investors seek the optimal balance between returns and fees. The future of active ETFs is a subject of ongoing exploration, with the market offering various perspectives and insights into their sustainability and potential for growth. Expert insights: the active versus passive debate is far from settled. While active ETFs have garnered significant attention, investors must weigh the potential benefits of active management against the associated costs and the concentration of assets within a few key players. The future of active ETFs is a dynamic landscape that demands careful consideration. Financial strategist, Laura Miller.